Yes, okay.
Okay, are we ready to start? Hi, everyone. This is Adele Goldberg here at Friends of Yad Sarah in New York. Welcome to our Plan Giving webinar. This is part of a series that we're doing to help people understand different ways that they can make a planned gift to the organization and also enjoy some tax-wise benefits that can help you. We have as our guest speaker today, our resident expert, Neal Myerberg, who will begin his presentation in just a few moments. I just wanted to let you know that if you have any questions, feel free to enter them into the chat, and we will have plenty of time for Q&A at the end of Neal's presentation. Any questions that appear in the chat will be posed to Neal in a real-time basis, and he will answer them as they come in. Thank you again for your interest and for your support of Yad Sarah. We're incredibly grateful for all that you do to help people in need in Israel. And without further ado, Neal, take it away.
Thanks, Adele, and welcome everybody, whether it's good afternoon or good morning. I'm glad you're here, and we're going to have one of our mini webinars today talking about leave a legacy, which in effect is kind of a phrase that we use to do your planning both during lifetime and after lifetime. That would include family, would include others who are important to you. And for many of you, if not all of you on this call, the idea of leaving something to charity, and particularly Yad Sarah, is probably very appealing. So the question is, how do you do it, and why do you do it, and what are the formulas? And this is the title, as you see on the screen. Let me just go through some things for you. Plan giving, and I'm going to take only a moment about this. Plan giving is what it says. It's making a charitable contribution as part of an overall plan. The plan usually contains tax advantages, contains the desirability for income, contains the idea of planning for retirement, talks about what we call windfalls, which are taxable transactions, any number of things that are essential in your planning, and also talks about how you pass assets by succession to the next generation. So who can benefit from plan gifts? You can see on this screen, older people perhaps, people who are trying to preserve capital, people who don't tolerate risk, may have an opportunity to realize capital gains, for example, concerned about perpetuating property, next generation, have assets in retirement plans. So many people have to plan around that. And lastly, predictable income, those who would like to have predictable income. So in essence, this screen talks about it. And then I lead to the point about using charitable gifts in estate planning. Why would anybody do that? Well, number one, and you can see at the very top bullet point, you exclude anything you leave to charity from estate and gift taxes. It just goes 100% deductible and no taxes on it. So that's just basically a bequest in a will. If you make a bequest saying I'm leaving $1,000 in my estate to Friends of Yad Sarah, then that $1,000 is excluded in the event there is any state or federal taxes, estate or gift that you may be obligated to. Number two, it's the whole idea of charitable gift annuities. Those of you who do, and some of you already have charitable gift annuities, know that those annuities are passing to charity after your lifetime, full deduction for them at that point, and again, excluded from estate and gift tax planning. Same with charitable remainder trusts. where you leave an asset or assets during your lifetime or after lifetime in a trust that will pay you or successors to you income for life. And those trusts eventually pay over to charity. You can name Friends of Yad Sarah or a number of organizations as a beneficiary of a charitable remainder trust. In a charitable gift annuity, the only beneficiary can be the charity who executes a gift annuity with you. That's because that's the charity at risk. Charitable lead trusts, very complicated but interesting in that it's a way for certain individuals, particularly who own real estate or things that have high appreciation possibilities, of leaving those assets to their children, next generation, and pay low gift tax or low estate tax, enabling the children to receive the assets free of any taxes on transfer. And lastly, for those of you who pay attention, I know most of you do, to retirement planning, whether it be 403Bs or 401Ks or IRAs or anything else other than a Roth, you realize that at the end of lifetime, without proper planning, those IRA sums are part of your estate, and they could be taxed to you as part of income received end of lifetime. Most planners have found strategies for doing that, including having them passed directly to the next generation. Rules apply to all the planning around IRAs, but the rules are pretty favorable. When you do your planning and go back to your planner after this conversation, ask your planner what kind of planning has been set up for my IRA, for my 401k, to be certain you're on the same page. What about testamentary planning, which is what we want to talk about most? People create bequests in their wills specifically to be certain that assets that they own after lifetime, individually own after lifetime, will go where they want them to go. So an easy way to provide for charity is to say, in addition to all the bequests you make for family members, friends, etc., you can also make a specific request to say, I leave the sum of X to charity, and you could say to be used for, case of Yad Sarah, any number of things that are done in Israel. You could say without restriction, trusting Yad Sarah and Friends of Yad Sarah to choose what's best needed at that time. You can create an endowment fund. You can create a special fund. You can do pretty much anything you want to be certain that the assets you're leaving to charity end of lifetime will be used as you select. And it's important to know that you can do this by a specific amount or a percentage of your estate. And that way, in the specific amount, you'll know exactly the dollar figure that you're leaving to your charity or charities. With a percentage amount, it's usually a percentage of the estate that remains after specific bequests, expenses, creditors, executors' fees, etc. That's called the residuary. And in that case, you provide a percentage of the residuary. There are many estates I'm familiar with where family members are either well provided for before the end of lifetime of the older person, or there are no family members who simply say, I want to leave my estate to the charities I like. I was talking with a woman yesterday who has 3 charities in mind for her estate distribution, and she wants to be certain that she can say in her will, 1/3 to charity A, 1/3 to charity B, and 1/3 to charity C of my residuary estate after payments that are required of my estate as it's administered, and that would be executed. That's a residuary bequest stated as percentages and not stated as a dollar amount. And then lastly, you can see the second bullet point, the idea of designations and retirement plans. The way to provide for charity and to really be tax efficient is to designate charity or charities as beneficiaries of all or a portion of your IRA, all or a portion of your 401k, and designate them in the document. And that way, end of lifetime, it goes directly to charity. That portion anyway goes directly to charity and removes the possibility of any estate taxes or any income taxes, because there is no income being recognized by you or by your estate at the end of lifetime. So in essence, bequests, designations, and retirement plans are 2 ways that people can do this in a tax efficient way. There's no income coming back to you for these. These are outright bequests or designations. There are ways to do this with income, and we're going to talk about that in a moment. Here's sort of a visual of bequests, planning bequests. You can see in number 1, the individual who includes charity in a will or trust. It could be a will, or it could be a living trust. In some states, people have living trusts to use in order to avoid probate and pass everything through the trust. And in some states and jurisdictions, people prefer wills because that's custom and because perfect title passes through wills. So in this case, the individual includes charity in the will or trust. First of all, in the will or trust, there's provisions for family heirs, and there is provision for a gift of charity. We say a gift that costs you nothing during lifetime, because you're making the gift only after lifetime. You're not depriving yourself of capital during lifetime. And so people just looking to do planning for their disposition of their estates, but don't want to part with any assets during lifetime, will generally in their wills or trusts make provisions for their heirs, for their friends, for their charities, in their wills or trusts to take effect after their lifetime. Fully exempt from estate taxes, and I know it's gratuitously a gift that costs you nothing during your lifetime. Well, it doesn't cost you anything during your lifetime, but in essence, anything you're giving away other than to heirs is a statement of support that is not family driven. It does save in taxes. It does perhaps do what you've always intended to do, but those assets are going straight to charity, not to your estate, not to probate, and not to your heirs. Now, using retirement plans, we said before, in this example, you can see here's IRA assets. And IRA assets, and this is just showing quantity, can be diminished substantially because of what we call the double tax after lifetime, unless certain planning mechanisms occur. If you name the charity as a beneficiary of all or part of the retirement plan assets, the donor's assets are received at balance at donor's death, but we've reduced those assets going to charity from the pile of taxation to make the assets going to heirs more substantial. About gifts of life insurance. People who have life insurance oftentimes have old policies, perhaps not extremely valuable in terms of death benefits, but they're assets in the estate. And even though it's a life insurance policy, it's still counted as part of your estate in terms of whether or not there'll be any estate taxes due at the federal or state level. You can transfer a policy to charity during your lifetime. You can designate the charity to be the owner. Charity would become the beneficiary. It's irrevocable. You make a deduction, you get a deduction, income tax deduction for what the value of the policy is as calculated. The charity receives the cash value or the policy or proceeds at the donor's death. And as a consequence, that's out of the estate. It's something you didn't intend to leave the heirs anyway. So if it's going to go to charity after lifetime and you don't intend to use it anymore and it's paid up, giving it during charity during your lifetime, it means that you're going to get a tax deduction for a value of the policy of what we call a fully paid up policy. So I'm commenting on the bottom, donation of a policy where you continue to pay the premium is a bit of a different story. If you have a life insurance policy that continues to have a premium due, for example, a term policy, which has no cash value, you can make a gift of that to the charity. Wouldn't be any tax deduction for doing it, but you can make the premium payments either directly to the insurance company or by an unrestricted gift to the charity. And in fact, you're deducting the premium payments every year as an income tax charitable deduction. I say on the second piece on the bottom, cash value policies are usually better than giving term policies for the charity because term policies could run out because there's no accumulation of cash value, but cash policies where they're paid or being paid through the premium, through the dividends, will have value to the charity either on receipt or at the end of lifetime. What about a life insurance policy where you simply name the charity as the beneficiary as opposed to giving the policy to the charity during your lifetime? Well, that's a statement, much like you do with an IRA, where you designate, in this case, the charity to be the beneficiary after your lifetime, but you continue to own the policy. In effect, you have the right, if you want, to change the beneficiary back again if you want to. But if you designate the charity as the beneficiary and you don't make changes, the policy will pass to the charity with 100% deduction. You can designate, as you can see on the bottom of the screen, you can designate multiple charities or multiple beneficiaries of a life insurance policy. So charity can have a piece, your heirs can have a piece. You know, and also, as I put out on the bottom, for younger people, people who are looking to plan their philanthropy as well as their estates, but are of the age like 40 or 50, where one is still acquiring not in the preservation stage of capital. One could say, look, I'd like to make a significant contribution to Friends of Yad Sarah to take effect after my lifetime through a life insurance policy. I'll contact a life insurance person, an expert, a representative of the company I work with, and I'll say, look, if I want to give $10,000 a year to your company to acquire a fully paid up life insurance policy that will benefit the charity after my lifetime, what would that $10,000 a year purchase in terms of a death benefit of a fully paid up policy? People do that, and then they know that that policy maybe is worth $100,000 or $200,000. That policy would be payable to charity, to Friends of Yad Sarah after lifetime, but it's fully paid. And all the years you paid it, fully paid, one could argue that if that policy is in effect going to be owned by the charity, that it would be deductible contributions. In this case, perhaps the individuals do this looking to maybe have options to change from Yad Sarah or any charity later on. It requires, again, your estate planner, your insurance planner, look at these options because it's a way to leverage a significant charitable gift when you're younger in your estate using dollars that you could that give you tax advantages and give you an opportunity to make a larger gift because you've done it at a younger age, not to take effect till the end of lifetime. What about endowed and restricted funds? This is kind of a concept we want to discuss about. There are people, perhaps many of you, who have been giving to charities, your favorite charities, for many years. You give regularly, doesn't necessarily have to be large as that word may be defined. One could be giving $180 a year, a high gift, any number of ways to be giving, but giving it every year. I will tell you this, and you might find this to be curious. Charities that I talk with say that it's very important for them to have major contributors on an annual basis. Of course, board members, major donors, these dollars are important for the charity's work on a regular basis. But charities also say it's even more important to have people who give regularly year by year. They're making a statement of support. They're probably thinking that they can't really part with capital during their lifetime. One never wants to outlive one's assets, so they give nominally but regularly to charity. Data suggests, experience suggests that those individuals oftentimes in their estate planning make provisions for charity after the lifetime that are significantly larger than one might expect because the assets have been retained over life. The giving to charity has been as much as they wanted to, but the larger amount is coming after lifetime. It's very consequential when people think that way. A story I might tell you. A woman years ago that I met at a presentation about charitable gift annuities said to me after the presentation, I have $25,000 in cash sitting in a savings account. Most of my income comes from being a retired teacher. I get Social Security, I get some other income. My cash and my assets, except for my condominium apartment, are very small, but I've got $25,000 in the bank earning little or nothing. So I think what I'll do is I'll give it to the charity now and buy a gift annuity. I'll get more income that way. I said to her, your generosity has been evident every year. You've been giving $100 every year. The charity appreciates you so much. But I don't think you should do the $25,000 gift annuity because by doing that, you're taking away money, liquidity that you might want to use as you get older. You might want to use it for travel. You might need it for certain situations. It's not large money, but it's money that you can control. I don't think you should do it now. And she looked at me and says, you told me not to make a charitable gift while you're talking to me on behalf of the charity you're speaking for? I said, yes, I think that the better course of action is to wait. Well, she did wait. Some years later, when she passed away, her will was probated, and she left to the charity a significant amount of money, not only that $25,000 as it grew, but also some assets in her IRA and 401ks that we didn't know much about. And the comment she made to family, and family told the charity, was that mom thought so much of the fact that she was told not to make the gift annuity. It wasn't the right thing to do at the time, meant that she felt so close to the charity and the charity's mission. The point I'm making is that making a contribution to charity has to fill a bunch of holes that you're trying to take care of. A, income. B, preservation of capital. C, the ability to feel comfortable with what you have so that you don't feel like you are going to have less later on. And D, your desire to be specific and generous to charity, waiting until after lifetime to do it, that way to be certain that you aren't impacting your lifestyle during lifetime and getting tax deductions to boot. Small story, but it's the way people think. Many of you think that you want to really be certain to take care of charity during your lifetime. Let me say that charity wants to be equally certain that you do it having thought through all the pieces involving income that you need, tax savings you want to have, protection of assets, and taking care of philanthropy later on. So it's a partnership. It's what we call donor-centered giving. The donors' issues and interests are primary. The charities, believe it or not, are secondary. When you think about this and you do your estate planning and you talk to your lawyer, your accountant, and you say, I have a very close connection with some charities, including Yad Sarah. I want to make provisions for them. If your planner says, let's be very patient and thoughtful about how we do this, it isn't because your planner doesn't want you to do it, because your planner is looking at the bigger picture. So I want you to be thinking about that. But if you decide you want to do it, and you decide you want to have this gift you're making to charity after a lifetime to have a lasting significance, of course, any gift you make will have current significance, you might make a provision in your will or your trust or an agreement with Yad Sarah during a lifetime that won't take effect till after your lifetime, that you want to create a fund in your name, in your family's name, a fund that says, the sums I'm leaving to friends of Yad Sarah for Yad Sarah after my lifetime shall be used to provide care for fill in the blank, to be used to provide equipment for fill in the blank, to be used to provide education and help and training and medical services, fill in the blank. You can do that by making your fund named and restricted. It's a conversation you might want to have with Adele and some others at Yad Sarah to express what you're trying to achieve. If you do it as a fund, it can be an endowed fund, which means it will run in perpetuity forever after your lifetime. It could be a kind of what we call quasi-endowed fund that could run for a certain number of years and will be measured and ended at a specific period of time. It can be principal, never used, only income. You could give charity the right to use some principal. You got all kinds of flexibility. You can name it, you can designate it, and you can give the charity the opportunity to assess needs, because think about it, as much as you love the work of Yad Sarah in Israel, as much as you support it by giving to friends of Yad Sarah, you know, we all know that the best judge of where the money needs to be used at a specific time is sitting in Israel, looking at what has to be done, who needs to be helped. And so assessing needs is a charity's role. Creating a special fund, endowed or restricted, any fund which carries forward your name and your family's name, is what we call, and I don't mean this to be unflattering, purchasing lifetime recognition. Why not be remembered publicly if you feel comfortable, publicly if you think your children and grandchildren will feel comfortable, that you made a difference by creating a fund that has your name at the halls of Yad Sarah, at Friends of Yad Sarah, in literature, because in effect, you're taking care tomorrow of what's needed today. You could also, and again, doing your financial, estate, and tax planning, including your philanthropy, execute what we call a declaration of intent. Declaration of intent is not binding on you, although most people think when they've done it, that they intend to execute it. Things get in the way, things happen. As you can see what I've said here, declarations of intent are commitments for the future of the organization that you state in a declaration of intent document, principally on the charity's perspective, will encourage others to do the same. So there's a statement in the document that says, unless you wish it to be removed, I am doing this with the hope that it will encourage others to do the same to support Yad Sarah. You can state the commitment in dollar amount. You can state the commitment in the type of it going to be. Is it going to be a life insurance policy? Is it going to be an IRA designation? Is it going to be creating an endowment fund or a designated fund? Is it going to be an outright gift? You can state anything you want. But there's language that says in the document, I make this declaration understanding I can change it or revoke it at any time. Why is that the case? Because we want you not to feel bound unless you want to be bound, because things change. But if you make a declaration of intent now, albeit non-binding, you're recognized as part of the legacy society of Yad Sarah, of Friends of Yad Sarah, because it's a way, as I point out in the second bullet point, to evidence your future support through your estate, yet be recognized during your lifetime. So there are many individuals who will say to Adele as executive director, you know, Adele, I've left provisions in my will for Friends of Yad Sarah, not even signing a declaration of intent. You're recognized. You're part of a legacy group of people who've told Yad Sarah that you're including them in your will or your trust. Or you can do a declaration of intent to make it in writing, yet, of course, you can always change your will. You can always change your trust. You can always revoke the declaration of intent. So signing non-binding declarations of intent is a way in doing your financial estate planning to say to your charities, I will be there for you after my lifetime. All that I'm talking about very generically today, I encourage you to talk about with your family if that's how you proceed to make your plans. Sometimes I'm talking to an individual about a significant bequest, and the individual is ready to proceed, and I know the individual has children and grandchildren, and I will say, and I probably am overreaching, but I just feel it's important. Have you discussed this with your family? The answer is almost always yes, of course, and they're very encouraging. Sometimes the answer is I have not, because it's my judgment to do what I want to do. But I think it's an important question to ask, but most people do review this, review it with their family, because anything one leaves to charity, in essence, is that much less one leaves to heirs, unless one leaves to heirs the right to income for their lifetimes after your lifetime, and then it goes to charity, in which case the heirs are being taken care of for their lifetimes, and charity gets it in the future. Charity is not in a position to say, we want it to happen after your lifetime. Charity is only hoping that somewhere in the course of generations, that your instructions for charitable giving will continue on through your children and through your grandchildren, so that generations of your family will believe in the work of Yad Sarah. So in essence, I've given you this greater picture. Let me just talk about a few things quickly that you may have heard in prior webinars we've done, particularly this year. Gift annuities still are significant in the operations of Friends of Yad Sarah. Many of you have done them. The rates are quite generous. The tax advantages are significant. If you're doing it with other than IRA money, most of your payments, depending on your age, annually could be tax-free. End of your lifetime, the assets remaining in that gift annuity go to Yad Sarah. In effect, for you, it's a will substitute. You're taking assets that are low productivity of income, making the productivity higher, getting a tax deduction, getting paid irrespective of markets, a certain amount every year, usually quarterly for life, and paying your charity and a lifetime. So you could use charitable gift annuities. You can use charitable remainder trust to do that. I want to say to you that in our last seminar, we've been talking about what we call the Legacy IRA Act that was passed as part of the Secure Act that began January 1 of this year. You can now, for the first time, because the law never allowed it, take a qualified charitable distribution from your IRA up to $50,000, could be less, in a year, and use those funds tax-free withdrawn from your IRA to acquire a gift annuity. That was never the rule before. Before, if you took money out, even if you created a gift annuity, if that money was coming from your IRA, it was taxable first, then you got a gift annuity. You never would zero out the taxes on that. Now you can. One time only, in one calendar year only, could be one gift annuity for $50,000, could be 5 gift annuities for $10,000. If your husband and wife Spouses by law, both of you have IRAs. You can both create an IRA together, a joint and survivor IRA, using either 50,000 or 100,000, 50 from you and 50 from your spouse. Very important use, and it's just taking hold now. It's early in the year, but I've already seen significant numbers of people not only committing to it, but actually executing it now. It is a way of taking out required minimum distributions from your IRA, age 70 and a half or 72, and not paying tax on them and using them to acquire a gift annuity. So in essence, it's a subject we can pursue at another time, or by way of your questions, we're going to be able to do lots of planning for lifetime and for income. And you can see here as my final screen, if you are of these ages, and it's May 2023, look at them in decades of, in periods of 5 years, these are your rates for a gift annuity, 6.5 for 70, and you can go across the table, see how generous they are. Much of it tax-free, as you can see below. We don't know the tax-free portion, so we know the month you're doing it. If you really want to know more, ask for a confidential calculation from us, and we'll be happy to tell you. Now, Rachel, I want to know, is there any questions that are pending that I should answer? I'm just going to check in with you right now.
I don't have any questions right now, but if any of you have questions, feel free to ask and Neal can answer them in real time right now.
Let's also advise that this session is being recorded and you can get the recording. You can also ask for this slide presentation. You can also request some confidential information, which will be shared with you and no one else. You can inquire about something that isn't even covered today that may deal with your estate and financial planning. We'll be happy to help. Looking at philanthropy as one of the methods that you might choose to use. We hope that at minimum you've got this information, that some of it might be new and some of it might raise enough thoughts that you might go back to your planners and get some help. I look at estate planning like I look at seeing my physician once a year for my physical exam. Every year one should look at one's estate planning provisions, look at one's trust, look at one's wills, inquire of your CPA, your lawyer, or your financial planner, what tax law changes may have occurred in 2023, what's looking forward to 2024. You want to plan ahead. You don't want to plan too late. Planning your estate should go on periodically and regularly and should be reviewed like you would review anything else that's important to you. So with that in mind, Adele, I'll turn to you to see if you have any final remarks you'd like to make to our Friends of Yad Sarah.
Hi again, everyone. I want to thank you very much again for attending and for your interest in supporting the organization. I would like to say that it's good to see you, but I think probably only you can see us. I look forward to seeing you in real life, as they say, at some point in the future, and I hope to hear from any of you who may have an interest in following up with me or with Neal to get any questions you have answered in a confidential manner. You can feel free to reach out to Neal directly for a consultation and to see whether any plan that you might have would be a good fit for you and what your intention, your charitable intent is. Certainly, we hope that Friends of Yad Sarah would be at the top of that list. The gifts that we receive through estate planning, through gift annuities, through bequests are among the most important gifts that are received by the organization on an annual basis and really help Yad Sarah and Israel to sustain critical programs that support the efforts of caregiving families all across the country. And we couldn't be more grateful to all of you for helping to make that possible. So I look forward to being in touch with you. I thank you again for your interest and your participation, and I look forward to hearing from you in the future. Thank you very much for your informative presentation, Neal, as always. And thank you, Rachel, for your help with the graphics and the technical assistance. Best wishes for a happy spring and a happy Shavuot.
Goodbye, everybody.